Hi, everyone. Welcome to the TimingResearch.com Analyze Your Trade, episode number 162 for June 15th, 2021. My name is David Kosmeter. I'm the creator of TimingResearch.com. Today, we will be discussing your trade ideas, and we are recording this at 4 p.m. Eastern Time. Today, I've arranged for Michael Filighera to join us, and you should be seeing his screen right now. And the option professor was going to be here as well, but I think he's having some technical issues, so he might be joining us in a few minutes, or he might be setting this this episode out. So Michael Filighera is here, though, and I'm going to go ahead and turn it over to him.
Thank you, David, and good afternoon, everybody. And I am Michael Filighera, and I'm with LogicalSignals.com and TradersHelpingTraders.com. And my background, excuse me, a little bit about my background is that I have been trading well over 40 years. I've been trading since 1979. I have been an options market maker here on the Pacific Exchange in San Francisco. I have traded on the London Traded Options Market, the European Options Exchange in Amsterdam, and the DTB Exchange in Germany. And that's where I got my first taste of electronic trading. Upon my return to the US, I continued to basically trade options, and until everything went electronic and things got very, very slow and there was no more pits, or there was no more necessity for the pits. And I then shifted back to my house, set up an office, and about 8 years ago, I made a decision that I really thought it would be better and more efficient to really work on becoming a successful day trader. And that's when I started to trade the futures, and since have built things up from there. Now, what we usually start with is a little bit of a view. And hold on, I just wanted to see what's going on. Okay, I don't know if my voice is sounding wobbly or if it's okay now.
There was a slight glitch every few seconds earlier, but it sounded fine. It's sounding fine to me.
Okay.
Now, so
okay.
I think it's
right.
okay.
Great. What I normally start with is when I do the Analyze Your Trade shows, is that I start with an overview of the S&P 500, the ES, and that's where I'm going to start today. And what I have is my hourly chart. Now, those of you who don't know me, I use Elliott wave theory and Fibonacci number sequences for my trading. And if we look at the S&P, if it gives me a chance to open up my little bit longer term chart. Oh, come on, computers. There we go. Let's all cooperate today. Let's start with the weekly chart, which is going to give us a pretty big overview. You can see, actually, I'm going to go out one more because I need to show the degrees. Let's go out to our maximum view. Here we have it. So these blue large Roman numerals are cycle level. And so here's the degree. The biggest picture that I run on is a cycle level. And then underneath that is a primary degree level. And then underneath that is an intermediate degree level. And underneath that is a minor degree level. And they also keep going down a little bit lower. And that's what we would use intraday. But for the purposes of what I'm going to describe, we are currently finishing up a cycle degree fifth wave advance. And this will then complete a very long-term cycle degree bull market, which basically started in 1974 in this current iteration of what's happening. So what we're finishing here is a rally phase that basically started in 1974 and is now reaching up to the sky for its ultimate top before we drop into a much larger corrective phase. So where we are within that is that within this cycle wave 5, there are going to be 5 waves of primary degree. And then within that, as we count them up, there are going to be 5 waves of intermediate degree, and then that breaks down in et cetera, because Elliott wave is building blocks. Okay, so having that, we are finishing up a primary third wave advance. Now, within that, now I can start to come back down. Within that primary primary degree third wave, we are in the intermediate 5th wave up. So we've completed 3 waves of intermediate degree, and now, or excuse me, 4 waves of intermediate degree, and now we're in the 5th wave up. And within that 5th wave, we have completed 1, 2, 3, 4 waves of minor degree. So that puts us in the minor 5th wave of an intermediate 5th wave of a primary 3rd wave. And this primary 3rd wave actually started back in, and let me go back out so I can be accurate. The primary 3rd wave started back in May or June of 2010. So it's been in force for 11 years and this month. So that's also quite an extended move, which is great, and was of course very tradable and included some severe downside and all of the above. We had lots of activity and lots of action. So here we are within this minor wave 5, and that we can see on our daily. Now I'm going to come back down that hourly chart and see if we can pick it up from there. So if we kind of come in now, when we're counting within a minor, they're going to be minute waves. And so we have still within this minor wave 5, we have 5 waves of minute degree. And those are labeled right here. So we have 1, 2, 3, 4. So we're in the 5th wave, minute wave 5, of minor wave 5, of intermediate wave 5, of primary wave 3. So now you can see this is the building blocks effect of Elliott wave, and now we're pushing up higher. So I have counted within this minute, these are subwaves. So it is breaking into its own 5 waves. And I had currently counted wave 1 and wave 2 of this last 5. And then the 3rd wave started to subdivide. And that's what happened here. So this would be wave 1 of 3, wave 2 of 3, and this is going to have to be wave 3 of 3. And this huge correction that we got today has thrown a spoke, or a stick into the spokes of our wheel. And so I'm not really sure, but other than it dipped down too far, it did not break a level which would have negated additional upside. So that level happens to be 42.24.5. And today's low was likely 28.25. So it got close. If it breaks that level, which it kind of looks like it likely will, then we're going to have to back up our count and see what's going on. One thing I always do is I allow the market to tell me, but if this level holds and it continues to go higher, then my expectations remain for it to build on the rally, to break again to new highs. So it had already done that on during Globex. It got up to 42.57.50 in the Globex session, before actually 58. Sorry about that. And before it started to drop off. Now, the intensity of the selling today, they're going to tell you all kinds of things of reasons why. But for me, the primary reason is that we have a quadruple options and futures expiration on Friday. That's a monthly. And then also at the end of the month, we have the end of the 2nd quarter. So what we've really got going on is a futures roll. So they're still trying to roll out of the June future into the September. And then we have portfolio managers, we have hedge fund managers, we've got everybody who manages large accounts, that they now are back into shuffling positions. What do they want to get out of? What do they want to pump up? What do they want to keep? And so we've got a lot of these indexes movement between stocks. And so that's providing some very quick moves that are really fast and then jump back in the other direction. So what does that portend for us? I really do believe that the market is going to hold these levels and now continue to go higher. In fact, this is actually a very nice 5 waves down. Oop, don't want that. Get away from me. And so I'm going to be looking for the market to move higher. I'm going to look at to finish this minor wave 5 by again getting back up to new highs. It probably doesn't seem very realistic from here. And then to start to break back above 52.50, 42.58, come on. And then to move on up towards actually these upper levels. This would be the minimum, this 100% number. This would be our minimum, and I want to shut that thing off, but it's not going to, okay. And get itself up to 42.76, 42.82, and ultimately up closer, if not on the nose, 4,300. That's the ultimate top that I think is going to come in up in that area. And again, I don't rest all of my money on that because as a trader, I continue to trade what's in front of me. This is what my interpretation of the pattern, of the long-term pattern, of the short-term pattern, and putting it together as building blocks, and that's where it's telling me that it should go. So I still believe that today was just this sudden shift as traders get out of futures and roll into the next month futures and do that they've needed to do. And then also just as we start to be prepared, one, for the quadruple expiration on Friday, but then also for the end of the month in June. So higher levels for me and getting up into create new all-time highs. Now, depending on what type of a trader you are, so in other words, are you a swing trader? Are you a long-term trader? Are you a position trader, et cetera, et cetera? This information is going to be more pertinent to you to be applicable as to what level you're trading on. I'm a day trader, so I don't carry positions overnight. But if people are carrying positions overnight, then having an idea of where we're going does become more helpful. Now, position traders and somebody who's on a long-term position, I think you need to really start thinking about what you want to do to switch things up, because this market will not stay up. It will begin to fall. And then, so I'm actually recommending that people have to do some shifting around for themselves and putting money where they think it's going to be most beneficial for them, or taking some off of the table, so to speak, and then just, working your positions from there, either by putting puts underneath them, but there's many different things you could do. Now, having said that, why don't we just give a start to see where we are on these individual stocks? And the first one up today is Microsoft. And let's see if my screen's going to, oh, that worked. Let's try an hourly chart, Microsoft. If I put up the right stock, wouldn't that help? Much better. Microsoft continues to have a really nice run. Again, this is the hourly chart. And the hourly chart, let me go up to where I put this on, because there was another time I did the Analyze Your Trade, and what I was looking for at that particular time was a corrective phase, and we got it. And that phase did come down to 0.618, it's a Fibonacci relationship, 0.618 retracement, and held twice, and now is building back up in the rally. So the first thing I need to do is to take off the retracements and realize that this is more than likely 1, 2, 3, 4, 5. It could maybe not make a new high, but it should get up and give that a good test before all is said and done. Now, this is a daily. The daily's a little bit topping out here. Momentum is beginning to wane, but then so did the market today. So it's just following what actually did take place. I also work with moving averages, and these are very, very short term for a daily chart. They're very short term. That would be the daily 4, the daily 8, or the daily I'm going to say 5 and 10. And then these are the 20-day moving average, the 50-day moving average, and the 200. They are still very much lined up on the daily chart for the market to continue higher. Now, what can we expect from this in terms of upside? One thing that I can do is we can try, because the wave that's coming up is going to be more related to this wave here. And so now what I want to do is just run some Fibonacci extensions that's going to give us a little bit of insight what we might be expecting moving up. And that's 38. There we go. So you can see that we haven't even reached, we got close, but we have not reached the 0.618 level, where this, again, likely be a fifth wave, is as it's related to the third wave. So the most common is that it's going to be 0.618, which is right there at 262.14 to 262.20. And then we have the next level up at 265. We have the current highs at, no, I want to get to that high, at 263. And that would suggest that we should get up and make new highs. And so the 618 is just going to get us right towards that level. This puts us at new highs. The next level of resistance at 269, let's say to 270 is, but the most common is that this fifth wave could be equal in length to the third wave, and that would come in at 277. And that's where I think that the market is going to be heading as the rest of its indexes that it participates in finish their upside potentials. But again, we have to let the market tell us. And so that would be my take on this one. Again, even the daily, it's getting a little bit overcooked up here. Doesn't mean that it can't go higher, by all means, but it does bring a little sense of caution. And we have gotten up to some levels very close to this next level of 262, where the market would find reason to begin to sell off, or move into the next pattern. And once this is complete, the next pattern would be that we're going to get a much larger corrective phase. And the way that that likely will be kicked off is pretty much like what we saw today in the indexes, where they just come in and they just start selling, and they just start selling until, but the confirmation is going to come when we move to the hourly chart, and you would see an Elliott 5-wave structure down. That's going to announce that the rally's over and the next corrective phase is now beginning and it's underway. Thus far, we're close. On the hourly, we're close to putting a 5-wave structure down. And that is not going to pretend all that wonderful. And particularly since it's coming off of pretty much almost the high. In the indexes, those 5 waves would have begun off of their all-time highs. So battle out would tell me that Microsoft does have potential, can get up, put in a new all-time high, at least for this whole sequence, and then begin to turn lower. So I do not look to put on long-term positions, bullish positions right now, because I don't think that that's generally what's going to be happening to the market. Okay, UUP. And that is Invesco, and that is, I think this is going to be the double bullish US dollar index. Yeah. I really don't have an opinion on the US dollar. So if I were just to take a look at this chart, the bias is actually like it's just trading in what I would call a box. So it's kind of range bound, desperately trying to get itself off its bottom here that it made back in the beginning of January at 24. We've gotten really close to testing that level here, basically testing it twice, and it continues to hold. But the market cannot really get itself in a decent rally coming off of this level. The way it ended up here was not very nice. That was a doji, and it just died very quickly. The dollar, of course, is tied to so many different things, and we've got a lot of inflation worries. We've got a lot of things happening that are real, and you would have to include that in your analysis of what you would think that this index is going to do. And being that it's an ultra bullish index, if the dollar were to rally, this thing should actually double time what the dollar's actually doing. And obviously the dollar's really not doing very much because it cannot get itself going. So, and again, here we are on a momentum basis already reaching up into overbought levels, which would suggest on an hourly basis or a daily basis, we're going to get a little slide lower, and the chance it is going to go below 24. And what could drive that there? Failure for the Fed to actually deal with inflation, and if we continue to try to hold interest rates lower, that could make dollar holders like done. I don't see the benefit to hold the dollar. So we'll see. But right now, I don't like the pattern. It seems to be more of a 3-wave up rather than a building on a 5-wave pattern, which would suggest that we're going to start moving higher. We're not getting any of those signals. It's holding below a 50-day moving average, and that's still going to provide resistance. And that's right there, right where we are trading at 38, 24.38. If it can clear 24.38 and close above it, then you got a chance that it's going to run up to 24.78. But again, dollar's not been putting in huge moves to the upside lately. So I would kind of stay away from this one and maybe looking at an ultra bearish. TLT, all right. Those two go together. This UUP and the TLT, they go together. TLT is kind of sitting in the same boat as the US dollar. And interest rates, to me, sit at the top of the pecking order. Because we have right at the top interest rates, because that really controls everything, because that controls the money. What are you willing to pay people to borrow? Excuse me, pay people to take your dollars, and then what we're actually willing to pay in terms to borrow. So it affects a lot. And as we come down that pecking order, it's like first we have interest rates, and then of course we have the currencies. So we have the dollar, and then underneath that we have equities, we have options, we have everything that's related to the dollar. Right now, TLT's also putting in a 3-wave rally. That's corrective to me, and that suggests very highly that we may, because we're still sitting above the 50, but you see that this short-term one is beginning to hook and move back lower, and that's after today's trade actually. But that's so again, being that it's so short-term in nature, if we get a decent update tomorrow, or even the follow-through on what we're doing thus far today, then these would revert and start pointing higher. Then you got a chance of it running up and get testing or breaking the 200-day moving average, which sits at 146.56 or 146.50. I actually think that interest rates are going to have to start going up. I don't know how long that the Fed and the Treasury are going to be able to stave off inflation. And inflation is very real. I'm sure that everybody who goes to a grocery store, at least out here in California, we are getting smacked around by every time we go into the grocery store. What we normally buy every week, from week to week, is starting to cost up to $20 more per week. So inflation is very real. It's hitting the gas prices. It's hitting new car prices. I don't know if anybody's noticed that. but that's actually gone through the roof now. New cars are costly. Home prices are going back through the roof, depending on what area of the country you're living in. But here in the Northern California area, housing prices have gone through the roof. It suddenly has slowed down because people are realizing they don't want to borrow. And so what is keeping a lid on is rental prices, because now people are able to go and they're going to rent versus buying a house. How that all plays out is yet to be seen. But my experience and my knowledge of the markets are telling me that we cannot be attacking inflation by holding interest rates low. We cannot, at the same time, we cannot really struggle to get out of this economic downturn that we've been in for the last year and a half without holding interest rates low, without putting more money into our infrastructure, without doing all the things that we need to do to really get everything restarted. But in that process, we're seeing inflation suddenly start to come rising up and get itself up to where it starts to get concerning. So I don't think that they're going to be able to hold these rates. And I think that as much as they don't want to, they're going to have to start letting them rise, because that's how you stem the flow. You know, if cheap money is no longer available, then people that are giving dollars are going to be more willing to, because they're going to get a better interest rate. If I'm going to give the Fed my dollars for bonds, why would I want to do that at 1.25% when I'm staring at the inflation at 3.5%? That just doesn't make sense. So one's got to balance out to the other. So TLT, I'm steering clear of it. If I needed to position myself, I likely would be looking to be short bonds. And Apple, one of my favorite companies, is up next. Apple, I just think is one of the better run companies that has a tremendous storehouse of cash. I mean, they've got a lot of money sitting in the banks, but they take extreme advantage of the cheap money. In fact, most of Wall Street does, because that's how they do their buybacks. We'll buy back our shares, and because we're borrowing cheap money. In any case, Apple doesn't look so bad here. But what my take is going to be is that it's going to follow the broader market, because don't forget, Apple is a part of the Dow, it's a part of the S&P, it's a part of the NASDAQ, of course, and I believe it's also a part of the Russell. So all the indexes Apple sits in. And yesterday, when Apple caught fire, that's what supported the NASDAQ all day long to close up as high as it did in the beautiful rally yesterday. From this high, which was after earnings, first quarter earnings, and actually that was year end, sorry. We did get a beautiful 5 waves down. This can be considered 3 waves up and complete, which this then would suggest is just a 3-wave counter trend rally, with the trend seemingly being down right now. So here's what Apple needs to do. If its intent is to continue the rally, the buyers must return, and they've got to push it above yesterday's highs, which is 130.54. If it starts to break down below these moving averages and below the 20-day and the 50 days in there too. So let me drop this down to the hourly so we can see them. See, there's the 20, there's the 5, and there's the 10-day. So from there, if they start to break, it's heading here. Now this would resemble quite a nice little bullish chart, but look at that run up and then run back down. That's a topping tail. that's a very bullish engulfing. And it didn't last very long until the rally picked up. And this is a strong rally. So again, what we're really sitting in between is, again, the quadruple expiration. That's Friday. Then the roll of the futures, that's already been taking place. But more importantly, what we're also seeing is the hedge funds and the fund managers and portfolio managers who are position squaring in advance of the end of the second quarter. So a lot of people call that window dressing, but in many cases, it's not they're dressing the window, they're taking the window down. So they're going to exit positions. I believe that yesterday's great rally up into that close was more of just them position squaring. You know, a lot of the funds moving back in to Apple to show it on their books, or whatever they do, that's what I felt was taking place. This bar, I think, was the same thing that we got early this morning, but it kind of, ended up being closing right in the middle of the bar after going down and going back up before it started to really sell off. And I think that was more the market itself than necessarily Apple. Apple basically stayed down all day, but what it needs to do is to hold these levels. If it starts to break and gets to 128.82, then I'm going to start to look more that it's going to start dropping to 27, to 25, and then down towards these levels from a couple of weeks ago, back around 122, 123, before it takes a pause. And what you can do in that is you can start to put some Fibonacci levels to kind of give you some guides. So here we have on the daily, we have the daily 200 at 120.50. That would be a good target actually for this move, because I would anticipate that it's going to come below 116. If this indeed is all being corrective, and this is the A wave, and this is the B wave, and this is 1 of C, 2 of C, we've got 3 of C coming. And that's going to be a strong down wave. Now, Apple could put that off by kind of just continuing to pick up the rally. But I just, the pattern that I'm seeing right now is telling me no, that it's likely, it maybe gets up closer, but I don't think it can get above that. I doubt it gets above 137, let's say, before we really see some stronger downside. So it does look like Apple's going to be putting in a corrective phase, and it's well underway. And I'm just going to put some extensions on here. Come on, do that correctly for me. Thank you. And we're going to take a look at what it could do. Check it out. This is wave A, and now what we're trying to measure out is wave C. So again, looking at the relationships between these two wave sequences on the Fibonacci, is that the first thing is that wave C is normally equal in length to wave A, and that comes right here at 107.37. That's a $22 drop, pretty big. And actually, one of the most common is a 1.618. So the first most common is would be 100%. The second would be 0.618, but that's coming in at 118.57, and I would be looking for it to make a new high. Can it stop there? Yes, but we'd be looking at this pattern. That this is wave 1 of C and this is wave 2 of C. For wave 3, 4, and 5 to stop there does not seem very realistic. So maybe wave 3 will stop here, we get a little bounce, and then a wave 5 will bring us down to complete this move. Now, it doesn't necessarily have to come to 100%. All the wave C needs to do is just break 116.20. If it breaks that, it fulfills the requirement for the C wave to make a new low, in this case, because of the direction, a new low below wave A. That we then could consider the pattern complete, and for the next rally to start. But I would definitely be looking for like 16 down to 113.64. So this is the zone, the first zone that I would look for this to complete itself in. And ultimately, this would be an area that I would expect. Unless the whole market is beginning to drop in its larger corrective phase. Remember in the S&P, I was talking about how it's really finishing up a cycle degree rally, but more importantly right now, it's finishing the primary third wave. So we've got a primary fourth wave correction to put in. And that, remember that the primary third wave began in 2010. So we're going to be correcting 11 years of bull market. What kind of damage can this do to Apple, the most retail held stock and all the market sits right here in front of us? What are people going to want to do? So we've got a lot of factors in play here. And it doesn't necessarily mean that Apple is a bad company. By no means am I stating that, but it will have to participate simply because it's publicly traded. And as positions get changed and things start to roll through, this is what we can see. And again, coming right past the end of June, we start moving into the next earnings season, which is July. And with in mind what I'm looking for, it would not surprise me to see that Apple is not going to report the best earnings for this second quarter. So maybe they won't meet expectations, and maybe the other big players won't meet expectations. And so we'll basically have a down cycle in terms of earnings. And that would fit with what's happening. So essentially, all I'm really looking for the markets to do, and again, here at Apple, is just to kind of get back to reality in terms of valuation, in terms of where it sits and all of that. I mean, this was a new all-time high for Apple at 145. So those are incredible numbers, because if you do all the math and where that puts the stock pre-split, so if we have to take in all of the splits, this thing is sitting in the rafters. So just to bring it down, and I think that just opens the door for a lot more investment and a lot of other things. So I don't necessarily fear a corrective phase. I don't think they're necessarily spelling disaster, particularly at the level that we're at now. They're going to look like the world is coming apart, but in reality, it's not. So how you want to play that, if you're long Apple and you really want to hold your position, you might want to put some puts underneath it all. You might want to sell some calls against it. Something that's going to give you protection as things tick down. If you don't necessarily want to sell your stock because you like the dividends you're getting, you like what you've seen or where you sit, and you want to hold the stock, play it. Use the stock as your anchor and trade options around it. And that's going to help you as you trade all the way through. And I know that Jim is not here right now, but I'll tell you what, folks, you've all been listening to Jim for a long time. He is the man to contact to learn about how can I protect my position with options. He'll help you with that tremendously. Next up, JO. Barclays coffee ETF. Oh, there you go. Give me a cup of Joe. Coffee has been on a screamer, from what I understand, and it looks like it's pulling back. Again, I used to follow coffee, but I haven't in quite some time. And what I can say about this coffee ETN is that, of course, it's following coffee prices. Now, coffee prices are number one, cyclical. They're number two, based on what's happening to coffee crops around the globe. And so if one's ready for harvest and the other one's just being planted, and what's happening weather-wise in those areas. So there's a lot of factors that go into what is the price of a cup of coffee. So based on this chart, this recent high right here was rejected. And you can see it was rejected big. Then they bought it back up. and then it was rejected again. And now we're gapped lower, and then we gapped again lower here. Now, what I'd be looking for initially, this is a daily chart, is 42.22. That's the 50-day moving average. And the 200-day moving average sits below at 38.24. It's not tremendously above current levels, as we've seen in many other stocks. But right now, I've been looking for a move down to the 50. This daily chart is getting a little bit, momentum-wise, has been down, and it's very reflective of what has taken place. But it looks like it's kind of getting a little bit oversold. So maybe you get a bounce, and then you're going to have to pay very close attention to what does that bounce look like? Is it just a dead cat bounce, and then we revert back and we start going lower? That could be happening as well. Now, what I can see off of this low is this is kind of junky, and so is this. But we did manage to rally up. We came off in 3, very important, and now we're building on a 5-wave advance again. So if I take this out one more time, I wonder how much I'm going to get if I can look at this weekly. Yeah, it kind of looks off of this low, which is going to be in 2020, that we finished an ABC up. And that's going to pretend that we're going to do one of these down. Or break into something similar to this, an ABC down. But this is just the very beginning of that A wave. So on a weekly basis, not looking for a whole lot upside. I'm looking for more downside. You can see these, look at these huge gaps. And this even shows you the rejection of that high even cleaner. Rejected, rejected, gap, rejected. And that also might be the contract switch as well, but still gapping lower. Here, your next stop is going to be the 20-day moving average of 40.66 if it cannot get itself back above these very near term, short term. That's a 10-day, that's a 5-day. And if it can't get itself above that, then it has nowhere to go but down. And I would think, yeah, this does not look real good from this particular position. And the weekly is now turned. So I would think that this continues to go lower, and I would take advantage of selling rallies or positioning. You can use options, coffee trades options as well. You use options to trade that. Let's take a look at Boeing. Boeing. The weekly chart in Boeing. Boy, I tell you, look at that. That was the pandemic. Seeming such a long time ago. And Boeing took it on the nose during that one. And coming off of that, ABC, ABC. Yeah, this looks very corrective to me. And I'll tell you why. I have an A, B, C, and then an ABC down. So if I were to say that this is a complete ABC, this is another ABC, I would mark it as an X wave. And then this is another ABC, and that could be a double ABC correction up, which would suggest down and majorly down. And I couldn't tell you what would create that because basically Boeing's been pulling out all the stops to get itself back, upright and flowing on all cylinders, so to speak. So what needs to happen to get rid of that thought would be the market continues and breaks above that high. Don't think that's going to happen. That's based on the structure that if it was just a smaller pullback, it should have held that level. It has not, which tells me that it's likely going to come down and at least test the 50-day moving average at 225.50, we'll call it. If not, then break 219. Now, what's going to precede all of that is you keep your eye on these short term. Again, I'm going to go down to the daily because that's a weekly chart. So it takes a lot longer to turn that boat around. See here again, there you still had the 250, the 200 at the top, the 50 right below it. Now you can see that it's shifted, still in a bullish position, but beginning to turn. So the shorter term, the shorter duration, like the 10-day and the 5-day, those are sitting right on top of each other right here. And this market on a daily basis would need to pop and keep going to get these to turn higher again. You got the 20 sitting right up below all that at 245. The market got close, broke it below, we captured it. Actually broke it yesterday, but we captured it today. And then sits right on top of it. If it breaks below, look for it to drop to 241. And it really has to hold to keep rally hopes alive. If it continues to break down, then yeah, these are your next stop, and then below where it's been, they're below 220. So we have support right where it is, next level support 241 down to 240, and then 225 down to 220. Those are support levels that have to hold. Daily is getting a little bit oversold here. So maybe Boeing will get itself together, put in a rally, get it going all over again. And again, that will follow the market. The Boeing will go along with what's happening in the Dow, what's happening in the S&P. And if they can get a decent enough rally going, the Dow will just definitely perk up because it has a bigger weighting in the Dow. But right now, I like the fact that the Dow closed down, but Boeing managed to eke out a little bit of a gain. That's a positive. But I would think it's got to hold that 44. Below 44, look for 41. Below 41, look for 25. Those are the stops. Let me just take a look one more. Let's go down to the hourly. I rarely get through very many of these. David, if you got one that you want me to do, make sure I get in the next 10 minutes here. Give me a shout. I have silver. We'll take a look at silver because a lot of people are playing that one now. The silver ETF. Precious metals are absolutely my favorite, but precious metals do not like inflation. And so depending on what actually happens, we can see gold and silver take inflation and just chew it up and spit it out and rally anyway. Then you've got the ones where they're talking about if we start pushing up interest rates, then they're going to be selling gold because gold doesn't give you any benefit, right? It doesn't pay you interest. It doesn't pay you a dividend, and neither does silver. So it's just holding the metal. But gold, more than silver, is a storehouse of value. So I do not believe gold will ever go to zero. It's going to go down, of course, and it goes up, but zero, nothing. It will always have value. So if the world goes to hell in a handbasket and nothing has any value anymore, then bam. You're going to be able to take your pieces of silver and your pieces of gold into a shop and you'll be able to buy and do transactions. But let's take a look at this on an hourly chart. Boy, it's just one great big box, isn't it? So we've got 25 on the bottom and we've got 26 on the top. It's trading in $1 range. That's pretty tight. And I don't see it. I mean, it's going to do a lot if it wants to get itself out of that little mess. But it's done a nice rally off of this. And it got up here and now it's just pulling back. And again, this is just all little three ways besides that gap, which I think was just the switch in the contract. But it's holding itself right here. So if it continues to hold itself above the 50-day moving average at 25, then I'm going to be looking for a retest of at least 27. Get up to that high, 2640, 2650, and maybe on up to 27. But a lot has to happen. And right now, metals are getting a little sticky while we all digest and get through all of our inflation worries and interest rates. So there's a lot that keeps a lid on these markets. One thing that both of these markets don't like is uncertainty. So if we start to get some uncertainty in economically, some uncertainty geopolitically, they will react. But right now, I don't mind. If you're long, I would maybe think about putting something underneath it. I'm looking for a move down to 25, 20, or down to 25 even. And then if it can turn around, you're in good shape. JP Morgan. I definitely do not like the banks. Yeah, and you can see that neither does the market. The market's beginning to wise up. And I think what we're also seeing is just a lot of portfolio managers, fund managers coming in and doing some position squaring, the position shifting ahead of the end of the quarter. But this has just been now pretty much straight down for 1, 2, 3, 4. This is the 5th day down. So I would imagine we might get a little bit of a rally in this guy in the financials tomorrow. Or, you know, as we move into the end of the week and get itself back above. Right now, everything's kind of starting to point down. If we get this 50 to start pointing down, it could be serious, and we just start to fall. It's going to find support right here at about 147 on the downside, 140, yeah, 147, 146. Now that it's below the 50-day at 159, that's resistance. And you can see that in my little ones, the 5-day and the 10-day and the 20, look at the 20 all the way up there, turning lower from 160, 161. JP Morgan, not a very pretty picture right now. And if it can correct it, it's going to have to turn around. It's going to rally and has to rally hard. So if it puts in a nice up 3 or 4 day, that would be a good sign that we are now going to be heading back up. But whether we're going to break 167, big question, because you're going to have to do it by Friday, the latest next week. Because if we're shifting back into the financials, then I'm going to be looking for new highs. But if we're shifting out of the financials, then this is things I think is going to start moving down and heading towards the 200-day moving average on that one. Micron chips. Okay. Micron. I also really like Micron, but I don't like this pattern. This is the daily chart again. And what we've seen thus far is this first corrective leg, the intervening rally, and then the start of the next leg down. This could be, if it's going to be a 5-wave structure, 1, 2, 3, 4, can't be. So this could be 1, 2, and then a 1, 2. I could get pretty serious here for Micron. What could save its neck is if it gets itself back above the 50-day moving average at 83. I think it's sitting at. Yeah, 83.40. That would be very beneficial for Micron. If we get above 83.40, I'm looking for 86.60. Again, that would be putting in a new high above that. Yeah, it could. It definitely could. And then it's going to be more of a nice clean A, B, and then a C, which would be healthy for the market. But I don't see new highs. I don't see new highs above 97. Not right now. But I do see some rally. And the momentum does suggest as well. AMD is going to look pretty much the same, folks. So we'll take a quick look, see how many I can get done here in about 4 minutes. Yeah, exactly the same, except its moving averages are flat as a pancake. Look at that. Got the 50 flat, the 200 flat, the 20 is going flat, everything's flat. That tells you it's sitting in the range bound. And as far as AMD is concerned, it's not minding that because it's above $80. And I don't think it really wants to see itself drop back down to 72 before it continues a rally. Pretty sketchy, but we got a lot of news, and AMD is a very, very heavily traded stock. And the options are heavily traded as well. And so again, with quadruple, we're just seeing that it's actually staying range bound for that, which is not a bad thing. But if you're a day trader of the stock, you're hating it because you're not getting much movement. A little bit longer term, I think it's going to drop. And if it drops, it's got to hold that 200-day moving average. If it starts to break below that 200-day, it's heading for 72 or 70. And you can see below that, this is on our daily, got nothing. There's nothing else down here. You're going to have some points, but you're going to have to go all the way back to July of 2020 to find them. So it's to keep rally hopes alive here. In other words, rally getting it back towards 100, it's going to have to hold above 72. Below there, we're going to be searching for support zones. Oh, GDX, that goes along with gold. Gold is just going through its motions and doing a little bit of a correction right now. I do suspect that, of course, the miners are going to have to go right along with it. Now, the trick to the miners, folks, is that just because gold might rally $200 in over the next week or month, does not necessarily equate that gold miners have to rally an equal percentage. What I've always recommended, before you're investing in gold miners, I mean, the ETF is one way of getting a basket, but it's what it's costed each of those companies to get an ounce of gold out of the ground and refined. And that varies across the board. From I've seen as low as, like $900 upwards of $1,750. So it varies according to the companies and according to where their mines are and how long those mines have been in operation. And that really factors into their bottom line. Of course, higher gold prices is going to show a much more favorable light upon the miners because they're going to get more for the product. And hopefully it's going to get them far enough above their break even. And that's to cover the cost of mining. Right now, it's just kind of reacting to gold, and gold's kind of up solid one day, down solid next day. I mean, just last week we were above 1900, and now we've slipped quite a bit. We slipped $40 back below. So you're going to have to go along with what gold is doing. Right now, it's holding the 50-day moving average on the daily, and then you've got the 200 just below. That is all realistic. If these levels can hold, then I would say that this advance continues. So if anything, 1, 2, 3, 4, 5, it's a nice 5 waves up, and A, B, C. If we can get a nice C wave down, I can put a little bit in here, and I'm at 2 o'clock, and I'm going to be finishing here in 2 seconds, folks, I promise. Oh, I didn't want that one. I just want to finish this. Come on. Finish. Jeez, it doesn't want to help me out, does it? Put it there. Come on. Come on. I'm going to just say, I think 50% is going to end up right there. And that's where I'm going to leave it. I am very, very, very bullish on gold. So, but that is because I hold very long-term positions in the metal itself. So how do you want to balance that out? I'm always in favor of holding gold. Now, gold miners, I don't know. But I would definitely look for this to hold and the possibility they can run somewhere in between there and then pick up the rally again. I definitely would see that. So I remain bullish on GDX as well, with giving a little bit of room for a pullback. And that's where I'm going to leave it and turn it back over to David and say thank you very much.
All right, thanks, Michael. Do you want to say anything more about your site or?
Yes. Oh, good. Yes. Once again, I'm Michael Filighera. One more time, I'll just let you know. And the 2 sites that I am on and own are logicalsignals.com and also tradershelpingtraders.com. And if you go to, I also do daily video casts for the NASDAQ and the S&P, and those are on YouTube. So you can go to my YouTube station, channels, and that's going to be Traders Helping Traders is the best one to find me. And once you get in there, you'll be able to pull up my name, and then you can look at those. I encourage everybody to subscribe to my YouTube channels. And by doing that, you're going to be on my list. I am starting a new logical signals trade room, and that will be beginning on the 21st of June. And my focus there is going to be on education. And I really believe that education is very, very important in becoming a successful trader. And also, I'm combining that with personalized education and personalized coaching, where one-on-one, we can really work through what might have been problems for people in being consistently profitable. So once again, that's starting on the 21st, and look for a promo email, and then please do take advantage, if you have an interest, of the promo pricing, because they're going to be pretty good. And thank you again, David.
Okay, great. So yeah, lots of good info today. So just a quick reminder, be sure to subscribe to Timing Research on YouTube or your favorite podcast app to get access to Timing Research shows, or you can also just go to TimingResearch.com to get access to this, the recording of this event as soon as I can get it posted, or any of the past shows and events as well. So good solo episode today from Michael Filighera of TradersHelpingTraders.com and LogicalSignals.com. And that's it for today. Thanks, everyone.